What's up, guys? Welcome to Glory Investing Show. I can assume that majority of you have a car. I can also assume that some of you drive an electric car. When you mention electric cars, the first thing that comes to mind is probably Tesla. Well, today we won't talk about them. Instead, we will analyze Lucid Motors. Lucid is an EV company based in Newark, California that is a brainchild of former chief engineer for Tesla, Peter Rawlinson. The company's mission is to inspire the adoption of sustainable transportation by creating the most captivating luxury electric vehicles centered around the human experience. But will investing in the stock at this stage be beneficial for you? Speaking of things that are beneficial, it would mean a lot to us if you support our channel by smashing that like and subscribe button. Lucid is setting new standards for sustainable mobility with its advanced luxury EVs whose performance, range, and efficiency is appealing both to customers and investors committed to a zero-emission future. The company's differentiated proprietary EV technology, including its battery technology, which is currently powering every vehicle in the world's leading EV racing series, is underpinned by a rich portfolio of patents. Lucid Motors' EV technology suite was developed in-house, allowing Lucid Air to deliver outstanding efficiency with a projected range of over 500 miles on a single charge, ahead of all competitors on the market today. Lucid Motors' growth will continue to benefit the communities in which it operates, particularly in California, where the company is headquartered, and in Arizona, where the company has built its vehicle manufacturing facility from the ground up, as well as its in-house EV powertrain manufacturing facility. Additionally, with directly owned retail locations already open in California and Florida, Lucid will continue to expand its retail and service footprint across the US throughout 2021. Lucid currently employs nearly 2,000 people in the US and intends to continue growing quickly to support the company's ramp in operations, with 3,000 employees expected to be added domestically by the end of 2022. After weeks of speculation, Lucid Motors finally confirmed the SPAC deal with Churchill Capital Corp. 4. Churchill Capital Corp. 4 is a blank check company under the leadership of Michael Klein, a former Citigroup banker and Wall Street veteran. The deal will leave the electric vehicle startup with $4.4 billion in cash. However, it has not been easy for the company in the past. Lucid Motors once struggled over new funding before Saudi Arabia's sovereign wealth fund came in as a white knight. Since then, Lucid Motors has been hard at work prepping the tech-forward luxury Air sedan for its debut. Electric automakers caught the eye of many investors in 2020 as Tesla's stock price skyrocketed to new heights. Meanwhile, the largest automakers in the US are pivoting to electric vehicles, and this shift has many investors looking for the next big electric automaker that could bring huge returns. Electric vehicles are clearly the future of automotive transportation. EVs have unmatched power, are better for the environment than internal combustion engine vehicles, and can easily be updated with more features. Considering that Lucid Motors is a luxury electric vehicle maker, the company stands to benefit as the automotive market drifts towards an EV future. After speculative fervor caused the stock to go up to nearly $65, shares came crashing down once reality set in and details around the deal structure were finally disclosed to investors. The shares are said to be trading around $20 to $25 over the past few days, and there's a good chance Lucid Motors could double your money. The stock was overvalued at $65, particularly before the definitive agreement being announced, since at that juncture the special purpose acquisition company was still simply a pile of money trying to find a target to take public. With details of the transaction in hand, we will now take a look at what it would take for Churchill Capital 4 shares, which can change to the ticker LCID once the merger closes, to climb back to $40 to $50. Lucid has delayed deliveries of its flagship Lucid Air luxury sedan from this spring to the rest of 2021. CEO Peter Rawlinson attributed the decision to advice from former Ford CEO Alan Mulally, who is on Churchill Capital's operating team. will encourage Rollison to take the extra time to nail the product's quality. With the timeline pushed back by a few months, investors should similarly have patience for positive catalysts, with air deliveries being the most significant by far. Until deliveries start and Lucid begins generating revenue, investors should expect the stock to remain extremely volatile. It's also worth remembering that shares traded as high as approximately $44 on the day immediately after the merger was announced, so there is at least some recent evidence that the market believes Lucid should be worth that much even before deliveries commence. Much of the decline since the deal was announced can be partially attributed to broader weakness within the tech sector, particularly EV stocks that have been soaring, perhaps too high, on hopes for supportive climate policies from the Biden administration. Looking farther out, which is the time horizon that long-term investors should be focusing on, Lucid is forecasting vehicle deliveries of roughly 20,000 in 2022, which should generate over $2.2 billion in sales. There will be 1.6 billion shares outstanding after the merger closes in the second quarter. At $40 per share, that translates into an implied market cap of $64 billion, which might subsequently suggest a forward sales multiple of 29 at that price. At $50, Lucid would be valued at $80 billion and around 36 times 2022 sales. In order to justify such an extremely lofty valuation, Lucid would need to do a few more things. In addition to starting air production, it needs to ramp its manufacturing operations to actually execute on its growth forecast, which is no easy task. The good news is the company is already laying the literal groundwork, recently securing approval for the second phase of its factory in Arizona from the local zoning commission. The first phase, which is already complete, is expected to have production capacity of around 34,000 units per year. The second phase will bring that figure to 90,000, which is how many vehicles Lucid hopes to deliver in 2024, generating $9.9 billion in revenue. In addition to this, Lucid will need to ensure that it can deliver the type of product quality that customers expect from a $170,000 vehicle, while validating its bold technological claims: over 500 miles of range, the ability to charge 300 miles in 20 minutes with DC fast charging, and industry-leading efficiency that tops even Tesla, with real-world data and experience. If Lucid can accomplish all of this, it will pave the way for future growth opportunities in adjacent businesses such as stationary storage, and becoming an EV tech supplier to other industries like aviation or agriculture, among others. It won't be easy, but Lucid has a real chance of becoming an EV powerhouse, allowing the stock to double from current levels in the years ahead. Lucid expects to manufacture 365,000 electric luxury sedans called Lucid Air per year, starting with a production ramp-up in 2022. Revenue will be $2.2 billion and grow from there, assuming there is a continued demand for these luxury EVs. The company recently announced it had sold out of pre-orders for its high-end model. Keep in mind that Lucid will be competing directly against Tesla at this end of the EV market. And Tesla already has a huge lead over CCIV and every other EV car maker. The good news is that revenue for 2024 is forecast to be $9.9 billion and deliveries of 90,000 Lucid Airs. Based on this, CCIV stock trades for just 3.3 times EV to sales. However, at 5 times sales on a risk-adjusted basis, CCIV stock is overvalued. For example, for 2024, the median enterprise value to sale multiple of its peers is 4.1 times. Lucid Motors expects to be free cash flow positive by 2025. According to the company's projections, revenue should grow 149% in 2023 and 79% in 2024. This also explains why the stock appears cheap by 2024. Right now, Tesla stock is at about 8 times EV to sales. Assuming that Lucid Motors matches its own forecast, it is worth somewhere between $27.45 and $35.41. This represents gains of at least 19 to 54% above the price on March 31st, 2021 of $23.05 per share. So far, there are no analysts covering this SPAC stock, and that likely won't change until the merger closes. They will have a much more detailed analysis and valuation methodology. It is predicted that the CCIV stock will move up once the merger closes. This might be a good opportunity to acquire cheap shares of the EV maker. If you liked this video, then make sure to give it a thumbs up and subscribe to our channel for more interesting videos in the future. Also, hit the bell icon to stay up to date and be the first one to watch our latest videos.